Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. I'd like to welcome you to today's event, Managing Climate Risks, Financial Alternatives, and Infrastructure. Throughout the event, you may post any questions you have using the Q&A feature at the bottom of the screen. Questions will be answered at the end of the event. And now I'd like to introduce today's moderator, Adam Lickey. Adam.
Hi there. All right, hello everyone. And for those of you watching from home. So today we're going to talk about climate risk, but from a little bit of a different angle. Much of the discussion of climate risk today focuses on large-scale changes in public policy. Should we do something about global warming? Should we, whose fault is global warming? What are the political aspects? But that's not what we're here to talk about today. Today, we're here to talk about the fact that regardless of how you feel about climate change, the effects of changing temperatures and changing weather are being seen today in essential sectors of the financial markets. And people are adjusting to this. And people are making changes. Insurance and reinsurance companies are at the forefront of this because they're the ones who ultimately bear a lot of the risk. And they don't just protect against catastrophic events. When you think of hurricanes, that's a catastrophe. But they also protect against things like heat waves and hailstorms, which are in between. And we have a good panel today. We have two people from two of the world's largest reinsurance companies, who are two of the biggest off-takers of this type of risk, and from one of the think tanks that helps municipalities think about planning and think about working with the financial markets in order to try to mitigate problems and in order to finance their own changes. So I'm going to introduce each of our panelists and in turn and let them say a little bit about themselves before we go to the questions. So I'm going to start to my right with Edward Wojnowski, who is at Munich Re in the cat markets.
So I work with Munich Re in the global specialty insurance arm. Global specialty insurance arm. I've been with Munich Re for about 15 years, 5 in the States, 5 in Munich, 2 in London, and now I'm back in New York for about 3. And I do exactly what you mentioned, right? Looking at risk grant transfer solutions, particularly for those that have specialty insurance needs that fall out of the standard market. I'd like to talk a little bit more about that as we progress.
Next, we have Rachel Hafeker, and she's from the Milken Institute. And Rachel, you could say something about yourself.
Yeah, sure. Ooh, is that on? Do we feel like that's on? No, testing.
I don't think Rachel's on.
I have a really loud voice. Can you guys hear me? Okay, why am I whispering like it's my personality? So hi, everyone. I'm Rachel Hafeker, and I'm with the Milken Institute. For those of you who don't know, the Milken Institute is a nonprofit, nonpartisan think tank. We have offices globally, and we think about how to leverage the capital markets for shared prosperity. So I sit in our public finance program, and specifically, I lead something called the Community Infrastructure Center. Like Adam mentioned, we focus on supporting communities across the country to help them advance their community infrastructure projects. So from the time that they've conceived of a project, whether it's water, energy, broadband, housing, commercial facilities, to the moment that they actually start implementing it, there are a lot of challenges with moving those projects through. And so very excited to talk today about the implication, not only on the project side, but also on the municipality side and how they can finance these projects, despite maybe some of the risks that they are contending with. Excited to be here.
Thank you. And last but not least, we have Rishu Ranjan from Swiss Re, who runs the weather desk, and which is, by the way, a desk near and dear to my heart because 25 years ago was my first job at Swiss Re was being the risk manager for that desk when it was just started. So Rishu, if you could tell us something about yourself.
So, hi everyone, I'm Rishu Ranjan. I head the global weather and energy desk at Swiss Re, and you just heard Swiss Re and Munich Re are the top 2 reinsurance companies in the world today. And what I look after is also a part where climate and weather risk, but it is more like the normal weather you see. Yeah. Like what is sunny weather and all of a sudden it's going to pour, and extreme heat wave, cold wave. And these are quite volatile in nature, other than you won't hear Cat 5 hurricane happening every day. But you will hear that temperatures in Boston could reach 105 at times. Yeah. And those are heat wave could cause some massive, massive implication to the financial world. A part of my job is pretty much sitting between the insurance side and the financial market side, which is the derivatives part of it, where we deal with the energy commodities and the normal weather anomalies. So a very interesting field, and I hope to talk something interesting too today.
Okay, thank you, Rishi. Since everybody is dealing with slightly different issues around climate, I'm going to structure this as a set of round robins. And we're going to start with Edward, since he happens to be next to me. Sounds good. And so we're going to start talking about the mortgage market. So insurance plays a vital role in the willingness of banks to provide mortgages. They don't want to lend you money if they're afraid your house is going to be destroyed and you can't afford to rebuild it. And lately, many insurance companies pulled out of markets, whether it's Florida or California, and it's harder and harder to get homeowners insurance. So I was wondering if you could just start, since our audience is not insurance professionals, telling us sort of what the structure of the market is and where the reinsurers fit and why it's so important that we have this capacity of people who are willing to bear that risk.
Yeah, I'd be happy to. But first, I didn't realize I'd have not one but two Swiss Re guys up here. So
It's all right. I got my reinsurance from Munich.
Yeah. So insurance. If we start with just the kind of construct of insurance, if you have $1 million home, every year when you buy insurance, you're not paying $1 million, right? You're paying a fraction of that. That is a very efficient business model when you think about capital allocation. But the whole point here is it's a long way, let's say, from $10,000 to $1 million. So the challenge when happens with one fire, one home, one, let's say, severe convective storm falling on a house, that is a perspective where you have a single risk, a single issue. When you look at the macro level, at the portfolio level, all of those losses happening at the same time. Take it from a Cat 5 hurricane hitting Florida. That is a lot of individual policies that get called at the same time on the same day. And that becomes a tremendous financial burden to some insurance companies. Because again, they haven't collateralized the full limit. So it's kind of like a bank. If everybody goes to the bank and tries to pull out all their money, it's called a run on the bank. It's the same thing with insurance companies. And so what we try to do with reinsurance is looking at then how do we spread that risk effectively to make sure that there is enough money to pay policyholders. Insurance is a highly regulated industry. There are capital requirements, there are financial disclosures, there are now EU taxonomy, climate reporting we have to follow. So the state of the market is such where you have to take that risk and spread it in order for all parties to be able to manage what could happen in the future. Because remember, we don't know when there's going to be a Cat 5. We don't know when there's going to be a severe convective storm or a house fire. But what we have to understand is what is the risk tolerance that we want to take? And when we've breached that tolerance, I either have to stop writing business or I have to partner with the reinsurer. And the challenge right now in Florida and California is that you're seeing much more inflation in terms of what we thought the actual risk was versus what we have to pay. So again, if we have that $1 million home, maybe now it's 1.5 million. And at the time, we only booked for a certain amount of premium. So the amount of money in the system is just being squeezed by inflationary pressure, but also the fact, as you mentioned, some of these non-modeled, or as I call them, not well-modeled, things like wildfire, things like flooding, things like severe convective storms. These are very random. They're difficult to predict, difficult to model. And so what we've seen is a higher number of these events. Just to give you kind of an idea, from the period of 2018 to 2022, I know you'd mentioned Florida and California, but that is 90% more in severe convective storm losses than we had in the prior 5 years. 90%, that's almost double the amount of loss that you thought that you would have. When you're trying to then balance your portfolio, those are elements where you say, okay, I've got a problem in the center of the US, I've got a problem on the coasts, where would I cut first? You're probably going to cut where you're having the most losses and where the most individuals live, Florida and California.
So a lot of the market dislocation that we're seeing is really more of repricing or portfolio management within insurance companies and reinsurance companies, because the challenge right now is there's not enough risk adequate pricing for the risks that people are taking. And I think that that's what we're seeing right now is it's not so much that the markets are broken, it's just that we're seeing now a repricing of the actual cost of risk, whereas in the past, we didn't have that effect.
I guess, do either one of you want to talk, especially about the cost of risk issue? Either Rachel or Rishi, do you have any follow-on comments just about how that impacts the follow-on? If the price goes up too much, what do people do?
Want to go first?
A lot. From the public sector side, when we don't price risk correctly and we don't have a plan in place, we don't have necessarily a run on, a bond that's already been issued. We run out of money in the coffers. So a city has a fixed budget and they have a fixed revenue source. And when you have a disaster that hits that was unaccounted for and not put into place, whether it was when you issued that bond for that development, or you didn't account for the operating and maintenance of something over time, when that disaster strikes, it will harm your coffers as a city. And what that means is you no longer can allocate those dollars to public services. You may have to cut back on public services from healthcare to transportation to housing subsidies. And so pricing risk is really important. And maybe we're just having these conversations now, but the failure to price it correctly has led to an overrun in our budget at a municipal level that has harmed our ability to provide services to everyone for standard operating procedures. I would say not only have we historically not priced it correctly, the disasters are getting worse, and we know that they're getting worse, and we know that they're getting bigger, and so we know that they're getting more expensive. And so it's not a problem that's going away, nor can you just say, oh, well, we can't price that because it's too risky, or else we would never build anything ever again. The question now is, what do you do about that, and how do you grapple with kind of that tension of you need to price it correctly, but you also need to make sure that there's a mitigation plan so that you can get the funding that ultimately goes to needed services. And, whether that's a mortgage or whether that's a new school, both are necessary kind of realities.
I'll simplify it slightly from the perspective of the reinsurer, right? How we make money. So we collect premiums, we expect to pay claims, and the premium that we collect, we pay claims maybe 1.5 years, 2 years later. So there is an investment income that comes through, and that's how any company, reinsurance company, makes money. Now, if you look the last 10 years, what has happened? The yields have been record low. You have seen the zero rates almost there, right? So reinsurance companies are not able to make money on the investment side of the part. The other thing that is happening, as my good friend was just saying, that pricing adequacy. It's a cyclical business. It always goes up and goes down. Back in 2005-06 period when Hurricane Rita and Katrina, back-to-back hurricanes happened, the pricing went through the roofs. But it all corrected, and there were times almost for 6-7 years, and I think you would agree, right, that the pricing was at bottom low. So at that point of time, you might also say, like the buyers would say, that the risk pricing is so cheap. And in that regard, you saw the last 5 years, what happened? You have back-to-back wildfire, which were not costed for. Back-to-back hurricanes. There was in 2018, I think 3 hurricanes happening in one season. And the reinsurance model is that you diversify the risk is no longer happening. And you may blame it on climate change or any other cause. It was there that you don't expect multiple bad events to happen in one single year, right? And that created this capital issues, very regulated industry. So you need to charge for it to be present for tomorrow. Otherwise, it's not like, charge less and you just die down as a company after a few years. So in my view, this is cyclical a bit. Slowly, the reserves are built and things normalize. So hopefully on the buying side, the rate correction has started to happen already. So I definitely see this is something going to improve. And the second part is a reinsurance model is also not sustainable if you every time price high. So a normalization is a need, but I would also like to comment one more thing to the buyers of the risk, That's also the reason more people should buy insurance, because every time people who is more exposed to the flood and fire are going to buy insurance. Others, they won't know, right? People who are bad at driving, they would go for the higher rider and everything, right? Not the good driver. So the reinsurance could always make money if the risk kind of is spread. That's on us to keep expanding the market and somehow still be able to cushion those volatility as we see.
Thank you. I guess one thing you've all mentioned is the idea of spreading the risk around, which is fundamentally diversification. And I guess for that purpose, there's one of the big questions about spreading risk around. Rashu, you just brought up the idea of getting the people who might not have the catastrophe risk to buy some insurance. In the public sector, we have essentially, I guess, the federal government can come in and help us a little bit. They're the funder of last resort. And in the reinsurance markets, you do reinsure disasters around the world. So I guess as a follow-on, when we think about the diversification and the ability to diversify, does global warming hurt the ability to diversify in the sense that it impacts multiple risks in your portfolio as opposed to a risk in one reason?
Would you like me to
I'll
answer?
start with it.
Yeah, I think the biggest challenge, as was said, is the idea of having multiple events in any one year. So you want to have a fair spread of your portfolio. This is why we have global operations all around the world, because the idea is you're looking at a perspective of what could be the worst case. What is the risk tolerance that I as an individual company can bear? So for Munich Re, we often look at the world and say, nowhere do I want to have more than a 1 in 1,000 year loss occur where I can't pay for it. So we are well capitalized, and that's a huge principle of us being a conservative company, so that we have enough money to balance those risks that we're taking around the globe. But we are seeing issues where some of the perils that are coming, or that are, for instance, there's just flooding now that we've seen in Dubai. The challenge here is that around the world, all of the climate change activity that we're seeing, some of it is insured, some of it's not. And so a big part for us is not only just looking at solutions for actually managing the coverage of that, managing the capital behind that, but also how do we make individual communities more resilient? How do we make communities stronger? How do we look at the risks that we're taking and not only just putting a capital number on it or a premium, but actually how do we help that individual move forward? And that's something I think Munich Re is looking at climate change. And we've been talking about climate change since the 70s, right? And people thought we were crazy back then. But the idea being that it's not just about charging more for the risk. It's changing the way that we're looking at risk and how we're accepting that risk into the world of our own balance sheet. Is that kind of where you were?
Yes.
Yeah. Okay. Okay.
You mentioned, and maybe this is a good segue for Rachel, working with communities to manage the risk. So obviously people have plans. In New York, we have something called Adapt NYC, which is New York's plan. How do cities, states, and other government agencies figure out how to do what to plan for, what events, and then how do they finance these events?
Two big ones, right there. So I think it depends on what a city's intent is when starting the process of designing their plan. So very proactive, well-resourced urban cities are in a great fortunate position often to have the capacity and staff to look broadly at their long-term planning process. So every city has to have a capital plan often if they've got a budget and they are a unit of government, but not every community is well capitalized to make a climate plan or to make a resilience plan. So I think we should just start with that as a very, very nice to have, and it's a luxury that a lot of communities across the country don't have. So if you are designing a resilience plan, just generally, so that in the long term, your goals may be aligned with reducing your carbon footprint, right? Maybe you signed on to a pledge that says we're going to reduce our greenhouse gas emissions. That's one objective. Another objective may be that you want to reduce your costs over time from the cost of unmitigated climate risk. That's another objective that you may have. The other may be that you are deeply concerned about equity and the distribution of climate disaster in communities that are most vulnerable to that risk. That's another objective of a plan. The intent of that plan will inform what you include in that, how you design it, and what the world of solutions are, because it will also inform how you fund and finance the components of that plan. So if you have a broad plan that says we're going to be net zero by 2050 with no teeth behind it and no financing or funding, that plan is going to be shelved and it will sit somewhere and it will never see the light of day. So if it's a good plan, you will include not just your planning agency, but also your CFO of a city so that you can figure out, okay, what is the right bonding roadmap that has to accompany that? You might include city grant writers because you might have to be looking at federal sources to subsidize that. You definitely want your electeds in a room if they're going to push for an increase in taxation to subsidize some of this. And so there are a lot of participants just on the government side that have to be involved in that planning process. And then the second piece of that is, what is the uptake going to be? So these plans could be at the municipal level, which that is great and awesome. And it's also not how most of these projects are going to be deployed. As part of a lot of these plans that we see, there's a lot that comes down to the resident. And so having that community buy-in early is going to be super, super important so that the adoption is there of these programs. And some of that adoption is going to put the cost of something onto a resident or onto a business owner or onto a developer. And so if they're not bought in, the uptake of that program might not be there. So you need all the right people in the room, which is barrier one, and you need a really clearly defined scope of what that plan is. What a plan is not is a muni bond disclosure statement. And that is very important because you are not accountable to anyone except for your voters, and you hope to God, they've forgotten about it in the next election season if you don't honor your plans. But a bond issuance is very different when you disclose your climate risk. That becomes more material, and that's a separate kind of conversation, but I think it's really important to distinguish between the two of those. We can go down a whole rabbit hole around all the creative sources of funds and financing to get to deployment. But the reality is it's going to be some blend of bond issuance, tax increment financing, depending on, the project types. It'll be on federal grants, federal subsidies, and then maybe even private capital. So that's another option is, as you're structuring a lot of these projects, there's a lot of interest in developing public-private partnerships, depending on the project type, that are of interest to a lot of private sector actors. So the blend will depend greatly, but I think just recognizing that the scope of a resilience plan will vary pretty significantly depending on what your objectives are.
Thank you. I don't know if Ed or Rishu, you want to comment on that a little bit about how your markets interact with it? I've got a question for Rishu about that if you don't have a particular comment.
Why don't we hear the question?
So you've mentioned that you deal a lot with things like heat waves, and municipalities have to plan for heat waves. But one of the problems with heat waves is sometimes they happen and you have a loss. So first of all, maybe you could talk about how the weather derivatives market lets people buy what's not technically insurance against heat waves, but works like heat waves and other types of weather derivatives. How does your market function as opposed to the insurance market?
So without going into details of the heat wave specific, I will make it a little bit more simple examples from the real one, right? I'm sure you all love chocolates, right? This is an awesome thing to have. And if you look into the price of cocoa right now, it's like looking at Bitcoin prices. Yeah. Mm-hmm. It's going through the roofs every day. It just keeps on going up. And what is the cost for that? Because of supply chain global issues, but back-to-back drought in Western Africa, right? If you look into almonds, another great food, every 10 years, California have one major frost season, which come late season, right? Which you don't account for. The spring frost, which kind of destroys 40-50% of the yield. Or take an example that you enjoy a nice glass of wine, French wine, and there is again an April frost and it kind of completely damages it. Now you might say that these are events which is never heard of. If an earthquake happens, everybody knows about it. Buildings are crashed, you can visually see it. But think about those producers who are exposed to such perils because what kind of insurance they can buy? You know, there was a frost. What to do? Nothing, right? It's not a property insurance. It's not any other insurance that goes through. And that's where weather markets come in play. They provide a solution to hedge against a specific peril, which is related to temperature or rainfall. And these are the examples which are more on the soft commodity side. What we do primarily, and where I see the bulk of the transaction in the market is on the energy side, right? Like you have heating, you have cooling, all is very much linked to how cold or hot the day is. And energy price is extremely volatile. To give an example, back at the time of Uri, which was a major winter storm in Texas back in February of 2021, if you wanted to have tea on one of those days or make a coffee, the prices were so high that it would have costed you $1,000 for a cup of coffee, just making in the house. Now, this kind of price volatility requires protections from risk takers. Banks not going to do it, right? Because this is not their standard product. And what we see as an insurance market is very diversifying. Again, going back to the diversification part, right? These volatility, even though looks quite volatile, but in a way it fits quite well in our portfolio against, let's say, nat cat risk or life and health risk and whatnot. So from that perspective, we see this as quite a complementary market, which helps reinsurers to further utilize their balance sheet to generate more returns in those times.
And are there people other than reinsurance firms that are risk takers? Is there a two-way market in the
That is
derivatives?
true. If you would follow the normal commodity news, I think various hedge funds, and I would not take the name of one of those hedge funds, they had the best year last year and the prior year. They made billions of dollars. Why? Because they just played on commodity with a view on weather. So these guys will kind of take a view that it will be a warm winter or a hot summer, and then speculate on prices based on that. So if their speculation is wrong, then these weather would be quite detrimental to their plans. And that is sometimes they come in the market and creates additional liquidity. Now, as a reinsurer, we don't see them as our end clients because our clients are the actual corporates, but we do see them at times helping us generate liquidity. So the two-way market does exist and we like it and want more and more people to participate.
Now, I'm going to turn to infrastructure. You mentioned Texas, which is an interesting power market. I don't know if our audience knows, but in most power markets, you can either get a fixed price for electricity or you have a somewhat capped price. Texas has a kind of funny market that there's no caps on the price, so it can go as high as it wants to go. It's essentially completely unregulated. And the Texas power grid got in some trouble. So do the Texas utility companies also play in this market to hedge against the power, or are they really sitting in the middle and they don't care in a sense?
So they don't play. And it's not fair to say that Texas is completely uncapped. You have put a price on the cap. Yes, the power can be -$5 per megawatt hour to up to $9,000 in past. Now it's about 5,000, which is still a lot, right? It can sudden spike. The reason they do it is that their view is that the price of electricity should be cheaper if you just let pure capitalistic approach play in. Improve your services, improve your grid, and then do it. While in the Northeast, particularly here, you pay extra electricity for capacity market because those are the grid's resilience. That it's like buying an insurance. That means you have an extra cost in your power bill added every month because you don't want to, get $9,000 prices during those cold winters. So I think both approaches have merit without going into the details. That's why they play it. It's the pros and cons, but I see that what they might have discounted in past was how bad weather risk could be. The anomalies are higher because and again, to the point of Dubai, as I said, right? Has it happened for the very first time in any major country, major city? No. Beijing in 2011 had a same kind of a rainfall which was leveled 1 in 1,000 year rain. Yeah. The problem is this 1 in 1,000 year events is happening almost every second year in some of the countries, right? So the same thing, like those utility grids should really adapt to what could be the new risk they are facing. Don't look into the last 50 years of data and say everything is good. You have to look into the changing risk profile of climate change, various other perils, infrastructure development, all has some form or other an impact. So
And in your markets, have you seen people coming in and let's stick to the power markets for a minute. But Rachel talked about infrastructure and you talked about how in the north we pay for extra capacity. So essentially the insurance is built into your electric bill. Have you seen the utilities in Texas investing in hardening the grid and doing other things to make sure that they can limit the volatility and therefore mitigates the swings in your own market?
yes, I think that one of the major thing that did was this winterization of the plants. Because who would think that Texas could have a 5-degree, maybe in Dallas or in Houston on one cold day, right? You never see such things. So they have a huge renewable, lot of wind turbines, but they all have a problem of icing. They didn't just work, you know? So they never planned in past because they had never seen such event. But the event that actually happened in 2021 had happened in 1989. I think there was also in 2000 that same event, but there was no wind turbine. So nobody knew those things, right? So that's why it's very important to plan for the risk, enterprise risk or any risk that you would like to call for. And then really either buy insurance or yeah, update your models and be aware that something can go wrong. But yeah, the fact is that they have done a lot of work in infrastructure upgrade since then.
If I could jump into something that I think is very exciting, that might not have been true even 2 years ago, is that 2 years ago, it might have began and ended with the utilities and the state and the insurance markets to inform the improvement to the grid. But I do think under this administration with the new infrastructure programs, both the bipartisan infrastructure law and the Inflation Reduction Act, that there are actually quite a few exciting incentives that now all of a sudden empower local community groups in whatever form there are, whether you're a nonprofit, whether you're a community lender like a CDFI or a minority depository institution or credit union, or a residential household owner, that you now have the option to not depend on a utility full stop to actually weatherize and improve your facilities, but that now there is actually financing, below market rate financing available to you to weatherize independently. So you're not just counting on a singular utility to get their act together, Texas, but that you've got the authority and the tools now to really make some of those improvements yourself. And so I think for communities that have historically maybe struggled with that relationship with the state, this is an opportunity to kind of even the playing field with risk management at a very, very local level.
If I can chat,
Sure.
because I think ultimately what we're talking about is really loss control, loss prevention, risk management. And it's not just Texas too. California, you have PG&E, which I think bought a cat bond specifically for the liability that they knew was going to happen if you have wildfires because of their utilities. So a lot of these elements that we're seeing, particularly in California, 90%, 95% of wildfires are man-made. If you remember Smokey the Bear, I don't know if that rings a bell with anybody, right? Only you can prevent forest fires. But it's things like this where it's also within the utility companies, it's within those that are actually providing this, that it is on them as well to make those investments into that infrastructure for the purposes of that risk management or what we're calling loss control.
As long as we're on, before I go to the hot end of the temperature spectrum, you mentioned the people buying a cat bond and people doing, and Rachel mentioned people getting money to essentially weatherproof themselves. Does the insurance market, has it adjusted to give people more credit to the extent that if they do improve their infrastructure, does that go into the pricing at this point, or is it still fairly broad-based? And just based on experience?
Yeah, I would say it's kind of two sides of it. On one side, if you're looking at homeowners insurance, for instance, we will value that at a replacement cost. So when we have a potential, let's say again, $1 million home, If at the time of loss, it's a $1.3 million home because of inflation, we will pay for that, right? Because of the nature of the contract that we have in. But what we're trying to look at, and states like California are leading in this, is, well, how do you harden your home? How do you make your home more safe? And there is an Institute for Business and Home Safety, IBHS, which is based in South Carolina. And they're actually a fund, Munich Re supports them heavily in terms of what are the things that you can do as a homeowner to protect yourself on a broader basis. And this is, I think, where the resilience comes in. And it's not just, though, on the communities of the individual, but it's also then on the municipalities. And a really great combination, if I'm hearing all of us speak right now, is to think, getting your plan together, understanding how you want to move things forward, looking at standard insurances in order to protect those municipalities. Munich Re specialty insurance, about almost 5% of our premium comes from municipalities, right? So we're heavily into that market insuring. But at the same time, you look at weather derivatives as an add-on or something to the effect of, what if there is a 3-foot storm in New York City for snow? And all of your investment or ability to have salt on the roads or ability to actually move all this or have all this, you're spending all of this extra tax dollars. So I think looking at parametric solutions as a complement to standard insurance, at the same time having a specific plan in place and understanding what are the things that I can do to make my risk a better risk, that definitely translates down into premium reduction. It definitely translates down into loss reduction. And this is where we're spending a lot of our time and energy on, again, focusing on that resilience, because we want to make sure that we're giving tools to people where it's not just, here's a premium increase, right? Do this, and then you'll get a cut. We really want to be a part of that in terms of a bigger way. So I think from my perspective, the answer is yes. So the very long answer to your short question, there is. But at the same time, too, to the point was made earlier, it's also a matter of numbers. And so the less people buying, the less money into the system, the less potential for diversification, the less capacity that there's going to be. So it's kind of one of those elements where we're all in this together. So.
If I may quickly add just one point to that. It all comes down, do you see risk management as a cost or as a value, right? Because, I mean, we also have like under my portfolio, we do generation outages. So if a generator is not performing during peak hours, then you kind of indemnify them. And we give credit to people who actually invested in winterization. Now, the good part is when you say those reduction acts and others are helping to kind of have a parallel grid of your own utility, right? Not reliant on that. It still requires a lot of investment. Somebody needs to pay for it. You either raise a debt. Debt is expensive if it is not protected properly. And insurance, if you're attached to it, the same debt borrowing cost reduces. So I see a risk management that might look like a cost initially is actually a value addition for the end buyer, comes both from the insurance side as well as the investment side, and it's a win-win scenario in the long term.
I will say a crazy stat is, I think 5 years ago, the Society for Public Administration did a study and they surveyed like 200 municipalities. 4 had an enterprise risk management system. That is insane. OMB mandates at the federal level that every federal agency has an enterprise risk management system, full stop. Municipalities do not do ERM well. It is showing. The entity within an organization at a municipal level that manages the budget is not connected with the housing department. They are not connected with the parks department. They are not connected with the Chamber of Commerce. And it's showing because they don't actually have a mitigation strategy. They've got a capital plan and they think that they just run a budget. They don't think that their role is in the day-to-day operations. But at the end of the day, these are not just numbers on a spreadsheet. There's operational transformation that needs to happen. And I would just say that that piece of kind of compliance and mandating the risk management piece, if it's not going to come from insurance providers, I think investors are another one that are kind of pushing the market to say, you've got to disclose. I will say one other thing, and then I will get off my soapbox for reform potential. MSRB is the entity that regulates the bond market in the US. They have no authority to mandate certain disclosures. So you've got investors demanding they need better data to price these bonds correctly. You've got an entity that has no authority, and you've got 90,000 potential issuers, 50,000 issuers that are not complying with the same standard of disclosure. So 7% have an ERM system. And none of us have a standard disclosure requirement. So I think understanding the market forces that are pushing for it is a very important piece of this as well.
Great. Thank you. So we've talked a bit about water. We've talked about wind. We've talked about cold. So let's talk a little bit about heat. So I'm going to start at the intersection of finance, not necessarily, I think it's probably mostly municipal finance, not to sound too much like the Princess Bride, but it's also involves the weather desk. So I'm going to start with Rajan. In particular in heat waves, we've seen some problems around airports where planes can't take off because the tarmac itself is essentially soft. Do people now buy weather derivatives to insure against those events? And how does that interact, sort of with a follow-on to Rachel, how does that interact with their bond offerings and how they can actually finance, shall we say, fixing the airports? Since obviously we have airports in places like the Gulf that are hardened up to higher temperatures than we have in the States.
So the short answer for that is, at this stage, they don't see it as a risk, which is big enough to buy a weather insurance for heat wave, particularly for a particular day. Yeah, they do buy covers. Like, for example, if you look into Dubai airport, it keeps on coming every time Dubai is today. All the airport is flooded, right, in that regard. So I think they see more as a major risk. Heat wave, I haven't seen or I haven't heard too much about it. And the way it also works is when they would have raised funds and some of the covenants and other things that were decided, in my view, they always keep some kind of a downtime that they will not be fully operational and the revenue already factors in potential losses of operations coming from those events. I believe if they keep on recording such things, then they might just come to weather derivatives desk or insurance, because everybody can accept volatility to a certain level. Beyond that, it's unseen and you want insurance protection basically.
Thanks. And Rachel, have we seen communities start thinking about their airports yet, or am I too early in this?
I mostly work with communities that don't have airports
Okay.
because they're too small, or smaller organizations. That's a behemoth that I unfortunately do not have a ton of insight into.
Sorry about that.
No, that's so fine. I think it would just be interesting to see if there's a cost share with the airlines themselves, if they had enough high priority airports that fit a similar profile, or maybe they are one of the ones that could have diversification.
Yeah.
Because they could split the cost. They're the ones that are incurring the cost of downtime. Or maybe FCC comes in and says, hey, maybe we should fix this because it's a liability.
I think they currently,
Not
some of
FCC.
them buy it, but they
Okay.
buy the construction delays.
Yeah.
Like not an operational airport, but if an airport is to be completed in, let's say, 3 years,
Mhm.
and there is a massive heat wave, the workers are not able to work, right? So you lose big man hours, many, many dollars in that regard. Then I have seen interest to buy such products, but that is more of the construction company rather than an operational airport.
So now thank you. Now I'm going to move on to the other end of heat, which is whole cities. So we've had some big heat domes in the United States the last couple of years. And we've had places where nobody really has air conditioning, like Portland and the Pacific Northwest. And now they're having to think about planning their infrastructure to deal with heat. What heat doesn't generally need to lead to things failing in the same ways as cold does, but it causes other problems. So what are cities having to finance? Because that type of finance is going to be very different than hardening your power grid.
Yeah. I'd say it depends on what their approach is to rectifying the issue. I think some cities are going to struggle because doing a retrofit and creating green roofs to counteract the heat is an effort that would be maybe more specific to urban areas that don't have or that struggle maybe more with like a heat dome than a more rural or spread out city. So I think it does depend on the nature of the project itself. I think that one exciting opportunity that cities now have at their disposal, and again, I think that although it is just a one-time injection of capital, what we're seeing right now as a byproduct of infrastructure funding coming through the feds is that it's creating a secondary market for there to be long-term financing. That was just not true 2 years ago. So one specific example is the Greenhouse Gas Reduction Fund is a $27 billion program out of EPA. They just announced their awards like a week and a half ago. And there are 3 awards under EPA's Greenhouse Gas Reduction Fund. One is Solar for All. I think that's something like $7 billion, and that is going exclusively to rooftop solar. But the other 2 programs is the National Clean Investment Fund and the Clean Communities Investment Accelerator. And NCIF is $14 billion, and the other program is, quick, someone do math. What's 14 plus 10? 24. So there's a $3 billion CCI. Somehow I've gotten these numbers horrifically wrong. Don't Google it later. And so CCIA and NCIF are really exciting because both programs can provide debt or equity financing for better buildings, for clean transportation, and for distributed energy generation and storage. And the reason why that is so exciting is because HVAC technology has gotten better and better and better over the years, and it's gotten more energy efficient. And the tooling is not the big HVACs that we think of, of our 20-year-old homes. There is new modular HVAC systems that are on the market that are fully commercialized, but have failed to deploy because there wasn't the right capital provision. So if you were to buy like a heating or an air conditioner and you're a first-time homeowner, you can't afford to add it to your house. But all of a sudden now you can finance one, and it's a lot cheaper than it used to be. And maybe you pay, this is so wrong, don't Google this either, $100 a month for 3 years, and then you recoup your energy costs over time. So the financing that is available to you now looks very different from what was available before. And so a city might not have to subsidize a developer in the way that they might have historically. So I think that there's a lot of opportunity, at least at that existential level, which is we need people to stay alive. So we need to make heating and cooling systems available at the household level, full stop, for everyone. And then obviously for our, our hospitals and our schools. I also think one last thing that I would like to throw out as a plug around heating is that there are studies now that show when students have a comfortable learning environment. I'm particularly thinking about communities that have their super hot summers and they don't have well-equipped AC units, that their quality of education plummets. And so making a justification to also improve your outcomes makes it a lot easier to lobby for increasing your funding for an initiative when you can link heat not just to costs and not just to like a level of comfort, but outcomes that matter to specific financing authorities. In this case, it would be a school district. So I think there are a lot of different creative ways to tell the narrative and then tap into new pools of funding, just depending on kind of what the magnitude of the infrastructure is.
Thank you. And I'm going to end the main question section, since I'm on heat, with a question for Ed, which is, and obviously the others can answer as well. Since we're talking about heat, we know that reinsurance companies worry a lot about cold and cold snaps, and we know they worry about storms, and we know they worry about fires. Is there much of a market at all around heat? Is there anything that is developed where that's considered a cat event, or is that really in the other markets, in the markets more on the weather derivatives?
I would say it's more on the weather derivatives. Because if I kind of try to take a lot of the different elements that we're talking about, like, for instance, the idea of, to your point on solar, investing in that from an energy production, putting solar panels in a house, putting solar panels on a facility, we've also just made that building much more expensive, right? Mm-hmm. And when we think about heat domes, to your point, in 2023, from a meteorological perspective, because we had a heat dome over Texas, it was actually rocket fuel for severe convective storm and hail in particular. And hail is becoming a massive, massive problem because what does it do? It loves to destroy solar panels, it loves to destroy buildings and infrastructure. And so the challenge now is, to your point, on where we're seeing pockets of heat. And we can maybe have a beer later and talk about El Nino to La Nina and the transformation of that and what we're expecting for hurricane season. But right now, heat, the waters in Florida are warm enough to support hurricanes. This is an unbelievable temperature amount that we've seen. And the challenge is heat, I think, to your point, in terms of a product, it's affecting all of our products. It's affecting all for which we're looking at from the market, because it's accelerating hurricane wind season. There's the hurricane season is expected to be the most active in that we've seen in the last 10 years, last 20 years. And that doesn't necessarily mean that there's more of a potential for landfall. But if you have another couple of hurricanes going after Florida, one of them is likely to hit. So the challenge is heat in general is just making it harder for some of these products, and they're getting hit more. And so when we think about the link then between municipalities and reinsurance and insurance, a municipality is not just going to go to a reinsurer and say, hey, can I get a cat bond for my solar panels on the school that I just put in, right? They're going to look at, I need a policy that covers both my police brutality, my sexual molestation claims, my all of the different school districts that we have, right? The water, all. So the challenge here is, how do you look at a product that can give the coverage that's needed, while at the same time the infrastructure is changing, right? The infrastructure is developing, technologies are being added to risks for which they weren't there before. So I think that there is definitely something there in terms of, again, resilience and how we look at communities. But the challenge is, as we're seeing from weather patterns, it's creating types of losses, types of risks that we just haven't seen before. And so the question then is, how do you plan for that? What is the cost of a photovoltaic parametric trigger for a school district, right? We don't know, right? So that becomes the challenge, is that only can we know the cost of risk once the actual loss happens. So we have to make a projection. So the idea, though, is not let's stay away from all. Let's leave the market. Some carriers are doing that. I think it's rather, let's come up with more innovative solutions that are more integrated into those communities to find better solutions for how we actually want to solve the needs of those communities.
I would just love, Ed and I are good friends. I would just love to make an ask of the insurance market in the same way that the health insurance market is, I'm pretty sure, like pretty big on not smoking, right? Like they've got a whole campaign out there. And they have all of these incentives to make us healthier so that we don't go have some problems in a couple of years. And I'd love to see the insurance market come play with the muni market and go bully some private capital providers into financing some of these projects in a really meaningful way, because I think you all are a behemoth of, capital, but more importantly, I think between you and the muni market, we could get some entities that are interested in playing. And I don't think that, at least the work that I've done, hasn't really thought of the insurance partners as allies in developing these solutions.
We're not always known as the most creative.
Florida's like, goodbye insurance, I'll see you in a couple decades. But maybe if we're a bit more proactive, then we could get a better solution.
I mean, just to kind of comment on that, I think insurance in general has a really bad reputation. Let's admit it, right? No one says, "Oh my God, I want to grow up and be a reinsurance underwriter," right? But I think at the end of the day, it's such a critical part of our economic activities and our economic growth. And so what I like about Munich Re in particular is that we're looking at the future knowing that things are going to change. And again, one of our core mission statements that we've just changed is, how do we help take risk off of people so that they can act bolder, they can act and be braver, right? And that's something I think that, of course, mission statements, corporate, but I really see our company moving towards that, where it's not just about saying we're going to do things, it's actually doing them. It's no longer supporting thermal coal plants, right? It's no longer supporting oil and gas as we're starting to exit into 2030. So it's really making those changes to the actual portfolio that you're supporting, but at the same time, supporting warranties for solar panels, supporting biodiesel, supporting new types of technologies that, maybe it's going to fail, but if you don't have that potential insurance partner, how do you actually try and how do you move that forward? So I agree with you. I think our reputation needs to change, our focus needs to change, and how we embed ourselves within that economic growth, economic activity has to be seen from a different lens. And I think that really falls on us, and in particular my generation, of where we want to take this insurance industry.
Are you hiring?
Well, that gets to the next question. We're going to open this up to audience questions, but we're going to finish with one question from me to all three of you. I think Ed introduced it rather nicely, saying no one grows up thinking they're going to be an insurance underwriter. You all work in various sectors of the markets that are highly intertwined between the capital markets and risk management. Yet you all work in things that involve global warming. How can people think about a career in this? I mean, the way you said it, it sounds, and I know my own experience with insurance has been somewhat accidental. I ended up there because somebody offered me a job doing financial stuff relating to insurance. How can people get involved if they're interested in working in this intersection of the financial markets and climate? And Rajan, I guess we'll start with you and then work back.
So I can start, and I would say I disagree with you on that. I think people love to be insurance underwriters, right? It's an exciting career, to be honest, right? And I'm joking about it. I myself come from an engineering background.
Yeah.
And then I work for banks. But given a choice, I will be the reinsurance underwriter or an actuary anytime it's one. Because very creative. And I get it. The old traditional side, I think big companies are evolving. So the way you see right now is that most of the companies are investing a lot in data, AI, getting new tech, being more savvy, being more aware about how the trends of the climate are erupting. And all these things requires fresh thinking, fresh talent. You need to be good quantitative person, good commercial person. And I think the solutions need to come, as you were saying, right? You're not going to do oil and gas. You're not going to do anything on coal. You want to do hydrogen. You want to do BESS. You want to do biodiesel. None of these products exist.
Yeah.
Mhm.
So at this point of time, who is best suited to build this? Not people like us who may have seen a half of their career, perhaps, but the young talent who should come. So even though you may or may in secret disagree with what I'm saying, but we have to say it's a great career path. You have to come forward and do it. So it's an exciting world, to be honest. What I like about my role in particular, I get to see one of the best models on the mathematical side, the quantitative, it satisfies the hunger that, okay, wow, what a great mathematical equation formulation to solve this problem, how the temperature on an hourly basis would behave, right? If I tell me what were the temperature here, what is the probability of 5 o'clock temperature here to be at 95 degrees or more? That's the mathematical problem to solve, right? It's very exciting. And then build it with data, link it with the actual problem of somebody facing or a tarmac issue or whatnot. The world is all out there to solve it.
I came to this like a little begrudgingly. My background was in tech and then urban planning. And then the further I got down the rabbit hole, I was like, oh, shoot, we got to fund this stuff, we're going to get it built. And so what I would say for those interested in getting into climate is get into place, because all of this is real. And I think when we sit too far removed and we treat it like an incident in an Excel sheet and say, that was a black swan, but not understand all of the things that led up to that, none of us should be surprised. Absolutely none of us should be surprised when Miami goes under next year. It's not going to, but if it did, like nobody in this room would be like appalled because the writing has been on the wall for 30 years. And that knowledge didn't just come from the markets that finally priced it correctly. It came from NOAA, 20 years ago that said, hey, that sea level is rising. So I think that the knowledge of place and all that goes into it, from how construction is financed, who's incentivized to build where, why was PG&E maybe not penalized for not having a risk management plan at the state level? These are a lot of questions that ultimately come down to the real world. And so I would just say that if you're interested in climate, and whether you take it in a more quantitative direction or you go policy or you go, I've run out of options with climate. I'm like, those are the two cleavers that we've got that root it in kind of knowledge of all verticals within place, from housing to economic development to transportation to construction, and then figure out, where you want to sit and what the right lever is. But it all comes down to real life. And so if you ever get into the carbon credit trading market, that's a good thing to remember as well. So that's my thought.
Well, so I have to say, I'm one of the weird ones, right, in a way, because I actually went to school for risk management. It was another major.
know
Yeah,
that.
yeah, it was another major that I'd picked up along the way, and I
have a little program in risk
a
management.
little bit,
Here, I
small
think.
one, small one. No, but I honestly thought I was going to go into marketing. I wanted to be Mad Men. I wanted to do the whole advertising thing, and I graduated in the financial collapse of 2008. And luckily, I had a risk management degree. Right? And so, I said, I'm one of the weird ones in the industry. But everyone that I speak to, whether you've fallen into it or whether you've specifically gone through it, everyone when you're in the insurance industry seems so completely different than when you're outside of the insurance industry, right? Because, what is your interaction with an insurance company? Well, they denied my claim, or I'm on call with them, or they want to do this and this and this and paperwork. But so the insurance industry, I think in the future is going to change dramatically. It's already changed from the 15 years that I've been in it. And again, I'm a small town kid from DuPont, Pennsylvania, right? So the idea that I had a chance to live in Germany and live in London. And this Sunday, I'm flying to London because we have our syndicate that we're now governing. So there's so many exciting things about this industry. It's such a global industry and people just don't often see that. So I think for me, to your point about how do you get involved in it, I think you attend lectures like this, but you also just try it, whether that's an internship, whether that's a job, whether that's just reaching out. Because for me, when I think of, if you're a data scientist, if you're a mathematician, if you're an investment banker, if you're an accountant, if you're a meteorologist, if you're a miner, any of these roles, Munich Re is a company of 1,000 careers. And we have doctors on staff, we have pediatricians on staff, because all of the risks that we're taking, we have to understand them. And how are we going to understand them if we don't have the people that understand them? So that, I think, is something when you think insurance, it's not just underwriter, actuary, claims person. There's so much behind that. And there's so much excitement there from my perspective. And to keep a statistic in mind, by 2030, the insurance industry will be about at 40% of all employees will be at retirement age. The amount of opportunity in this industry is going to be unprecedented in the next 10 to 15 years, I believe, because there's just not that much people that are excited about it anymore because they wanted to go into tech. They wanted to go into investment banking, but it's such a massive industry that's so core to all things that we do. So that's why I've loved it. I've had a great career. I've really, really enjoyed it. And for me, I'm just super excited for the next 15 years and see where that leads.
Well, thank you. So I'm going to open it up to audience questions if we have any in the room. Yes, and we'll start with you since you've got your hand up first.
Thank you very much for your insights. I'm an urban planner myself.
Woo woo.
Until this to understand it better, it is slowly something that in the work we do, and it is very fundamental to the way the city operates because cities like property taxes, you can't get mortgage, property value plummet, city plummet, fair. I have a question on understanding of risk, but understanding risk community-wide. And how well do you think the insurance understand? Especially because property insurance works as a product that insures the property for one. How will such an understanding, a more holistic understanding of risk and getting into it, how that holistic understanding could inform the kind of products insurance industry creates? Property insurance that I mentioned, as well as the math on making more financing available for the options that the community might consider, and maybe thinking of insurance as a piece of in and of itself, like how do you combine a seawall with and Rachel, one specific question for you. With this understanding of risk, how, or the limit of that, how does that impact the community's ability to prioritize such investments? Like, I'm a community, if I cover a part of my community with insurance, can I have a smaller seat? How do I make those decisions with a better understanding of risk? And if risks are too high, how to have complicated conversations.
So I'm hearing two questions on that side. I'll take the first one. I think you're absolutely right. The traditional mode of insurance is here's my risk, and then it's rate times unit of exposure plus expense plus profit. Okay, here's your premium. We do that on scale, right? Risk by risk by risk. And then what we then look at is of the portfolio that we've taken in, what is the potential for maximum losses from some of these particular events that we talked about? The challenge is, though, what is the cost of risk for a hurricane for Tampa or for New York City? No one's really looking into that. And that, I think, is where you're absolutely right, is that when we take more of a holistic understanding of what does that do to the community? What does that impact the city? Those are elements that I think the insurance industry does need to move forward through and be able to find risk transfer solutions that aren't just property and casualty for, let's say, the municipality itself, but rather looking at that infrastructure and how do we support that? Because to the question that you then had on making more finance available, when you remove some of those risks, that's when more financing will come in. And so I see it as a potential for insurance companies to develop new products, to be more holistic in the way that they're approaching municipalities or cities or infrastructure in general. Because remember too, we already insure a lot of infrastructure. Francis Scott Key Bridge is a great example of that. That's going to be a massive loss for the marine industry. And we're happy to pay because that's exactly what insurance is for. It's exactly an example of that working in a way in which now we say, okay, let's start rebuilding. So I think it's the question, though, of how cities will evolve, how cities will change. And I challenge you back in terms of help us understand those risks more, or what do communities need more? Or if I'm planning something, how do I take some of that risk away? I think that's where the innovation needs to come. And to the point that you had made, it's not just us driving it or us thinking of the products, because sometimes we're stuck in our old traditional ways of thinking. We need that new talent to help us get to that next level.
Yeah, great. This is a problem. I'm so glad that we're talking about this because the risk, yeah, it's gotten worse, but it is wild to me that cities have not considered that it would come to their doorstep eventually. And so I think that controversially, I'm like, yeah, what has Florida shown the insurance market that they're serious about rectifying the issue? That's not the worst outcome in the world. I think communities are a deer in the headlight because it's hard. It's so hard. And again, you've got your urban planning department, and then you've got your financing department, and they sit over here, and then you've got your consultants, and nobody talks to anybody within a community. And so what I think is really important is that there is not one solution. And so it's not going to be one insurance product. And it's not going to be one seawall. It's going to be an aggregation of several layers. It is like the egg with that school project where you're supposed to figure out how to like cushion the fall. Like the fall is coming. So the question is, what are the wraparound services that you're providing? And if you're just solving for insurance, you're screwed already. And I think the big thing is one, so there are three big things that I think a community should solve for. One is I think you need to focus on how do you prevent the disaster. You do. You need a seawall so that you mitigate the amount of flooding. You need stormwater improvements by creating more impermeable surfaces to prevent the outcome of flooding. So you're reducing the actual disaster's impact. And then the second thing that you can do is you say, okay, it's coming though. The flood is like on the way. You need to make sure that your community has the infrastructure to withstand it so that you mitigate the actual catastrophe. So the water's here, but do people have to, does it have to get into the home, right? And so that's where you look at weatherization. That's where you look at beefing up your infrastructure. That's where you say, okay, like if it's coming, how do we make sure it doesn't hurt people? And then you say, okay, it's here and it's in the house. How do you get those people fed, right? Where do you need your resilience centers? What's your exit strategy? Where are the helicopters going to fly in? All three things are going to happen. And so I think that in order to solve for the insurance issue, you have to solve for the actual crux of the issue so that not only insurers, but also investors in the bonding market are convinced that you've got a hold of it, because their biggest concern is we're going to insure this thing or we're going to invest in this thing and you don't have a clue. So those would be my recommendations or thoughts.
I know we have one more question, but we're pretty much out of time. However, I will say we do have some refreshments for you afterwards. So and they're telling me I have to wrap it up. So, so we are going to let you mingle with our speakers afterwards, so you will have a chance to ask your question directly in person. And I'm sure there were some other questions online, and maybe people will be happy to take email questions and answer them as well. If people who are watching online do. But I want to thank our panelists here. You've all been great, and you've all shown us that there are many aspects of dealing with climate change that are not controversial, but are in fact, we have real problems on the ground. We have to deal with them. And each of you is in a different sector of the market in dealing with those things. And it's been very useful for all of us. So thank you very much.